it's tricky, as you mentioned, for the analysts now to value development, right? And it used to be net asset value versus cash flow, and so now you're not getting rewarded as much for chasing those developments, at least in the public markets, even though you're adding a tremendous amount of value. So like, how do you think about development these days? And I think you guys just bought something up in, was it Oshawa or something, some $100 million acquisition? Like, what's your guys' strategy on the development side?
Well, I think you pointed out an important
Sorry, by the way, I know I asked like 8 questions there.
That's okay. We'll try and tease those out. Let me deal with the first one, which is development in a public markets perspective. I think, in the REIT structure that we have development, development is cash flow dilutive during the development period. And it also is adding a significant amount of leverage, right? And smaller REITs in particular have less appetite or less capacity, maybe a better word, to do a lot of development on balance sheet because of that cash flow dilution, because of the leverage impact. And so, and even for larger REITs, I would say development on balance sheet has probably become less attractive. Certainly there are some of the peers in the multifamily space like Killam who've done a fantastic job as a developer and have done, very credible work there. But I would say just so broadly speaking, probably less appetite for development in the public sphere. But on the private side, what we saw over the last couple of years certainly was a surge of rental housing starts and deliveries. And I've talked about earlier in this conversation about the linkage between new home and for rent, and they are very linked. And I'll say particularly for large urban markets like Toronto or Vancouver, where there is a significant, or traditionally has been a significant condo market. And that condo market was comprised in no small part by investor buyers buying on a pre-construction basis to buy an investment unit that they were going to put into the rental market.
Right.
And what we've seen over the last couple of years is that condo market, certainly in Toronto and Vancouver, but broadly speaking across the country, has really suffered. And certainly we're living through perhaps one of the most significant corrections in the condo market. We are still delivering, let's say, the backlog that was sold in 2020, 2021, and maybe the very first part of 2022. But as that pre-construction sales have basically disappeared and that backlog delivers and will deliver through 25 and the first 6 months of 2026, we're going to see deliveries of condos drop right off the cliff. And condos are a significant, particularly investor-held, significant component of the rental housing market. For years, Canada wasn't building purpose-built rental because of tax laws, because of the condo sector, which was just more appealing as a developer. So how we were delivering rentals was in the form of condos. And so as the condo market over the last couple of years has really suffered, and I think we're seeing starts fall, and we've seen condos
fall off a cliff.
Exactly. I mean, it's collapse, right? But what we saw sort of in parallel with that, or maybe at the same time as that was coming down, we were seeing a surge in new rentals happening. And part of it was fueled by policy change. We saw the change in GST for new purpose-built rentals. And we saw some other things happening. Then, of course, we had the immigration policy change in 2024, which kind of put things a little bit of a chill on things. I think that we'll see new starts of purpose-built rental probably settle a little bit. Certainly, when you look at the urban land market in larger urban centers today, land values still, are being held at sort of relatively elevated levels, let's say. It hasn't fully corrected, very few transactions. And sometimes the math is still kind of hard to make it pencil. I mean, there are deals that are starting. Certainly we're starting some, but a lot of it's on legacy land where we've been able to make the numbers work out. I think what we're seeing now is an adjustment as well certainly in the high-rise concrete construction sector, as those condo starts have really petered out. And you can look at the skyline, the room we're in right now. What we would have seen out of this, gorgeous boardroom would have been cranes, a sea of cranes on the skyline. And now, if you look out in an urban center like Toronto, there are very, very few cranes. And the cranes that you see are typically ICI related. They're not necessarily residential. And so we're seeing construction costs really sort of adjust back. In some divisions of your hard cost, pro forma, you're seeing going back to 2019 pricing, or because we saw through the pandemic inflation on the construction costs that just soared. It's come back down or coming down in some areas. And so I think that will help counter the effect of some of the other stuff that was sort of working against us. But that surge that we saw in rental housing, as I say, probably come off a little bit. But I think it's we're going to see more of it, and I'm optimistic about it.
Me too. So I guess what you're saying is by early 2026, less rental being developed, virtually no condos coming to completion.
Yeah.
That sounds like a bull run scenario.
It's fantastic if you're a provider or you've got deals in the pipeline that you're delivering in 2027 or 2028.
Right.
But as a country, it's not helping address our housing affordability challenge that we have, right? I mean, certainly the federal government has come out with some initiatives, getting rid of GST for new home buyers. We're seeing some changes at the provincial level in Ontario and other provinces to try and foster new housing supply. The effect of those changes in housing policy take a while to work through to fruition. And so we really need to give those time to sort of help us. But cautiously optimistic that, the industry will be able to respond.